This is the Retirement Lifestyle Advocates radio program. I'm your host, Dennis Tubbergen. Glad you decided to tune in today. Hey, joining me on today's program in segments 2 and 3 will be returning guest, Mr. Karl Denninger. I'm going to talk to Karl about the general state of the U.S. economy. I'm going to talk to him about what the end game looks like as far as getting all the debt out of the system. So you'll want to stay tuned for that. That's in segments 2 and 3 of today's program. I am offering a free report today titled Tax-Free Retirement Income Strategies. And if you'd like to get that report, go visit the website, requestyourreport.com. I'll be glad to send it to you at no cost, with no obligation. And when you request the report, Tax-Free Retirement Income Strategies, I'll also send you a copy of my best-selling Little Black Book on Social Security Maximization. I'll also send you a copy of the best-selling book, Revenue Sourcing, that contains a retirement planning strategy for the current economy. All that information is free, and it is yours by simply requesting it. Just go to requestyourreport.com. Often here on the program, I talk about the fact that your history professor or your history teacher was correct. Those who don't study history are doomed to repeat it. So starting with that statement in this segment, I would like to give you a quote from Thomas Jefferson, one of the founding fathers of the United States. Now, I understand that it's probably not in vogue today to quote Thomas Jefferson, but I'm going to do so anyway because he said something that is really, when you look at the current state of the economy, prophetic. Here's what Mr. Jefferson said, quote, "If the American people ever allow private banks to control the issue of their currency, first by inflation, then by deflation, the banks and corporations that will grow up around them will deprive the people of all property until their children wake up homeless on the continent their fathers conquered." Isn't that an interesting quote? Now, I want to give you another Thomas Jefferson quote. He said that the evils of this deluge of paper money are not removed until our citizens are generally and radically instructed in their cause and consequences. Jefferson made that statement in response to currency creation by the government. Jefferson was a hard money guy. Jefferson was fundamentally opposed to the idea that a central bank printing paper currency with nothing to back it up. He was convinced, and I think now when you take a look at history, he was right, that this is simply a bad idea. So to borrow that phrase from Thomas Jefferson, U.S. government deficit spending and the Federal Reserve currency creation have done exactly what Jefferson said. They have buried us under a deluge of paper money. Now, we see this in the form of inflation. When we go to the grocery store, when we go to the gas station to fill up our vehicles, we see that our U.S. dollars are depreciating. We see that our U.S. dollars buy less almost every single day. Now, the reality is this currency creation by central banks and by governments is nothing new. Governments, and more narrowly speaking, the U.S. government, has been depreciating currency since the earliest days of the Republic. Now, a lot of people today, and this is why I bring this up on today's program, excuse me, a lot of people don't realize what is happening. They believe the political rhetoric that inflation is due to greedy corporations. Inflation is due to Vladimir Putin. Well, the bottom line is that Jefferson was right. When you create currency literally from thin air, you devalue a currency and you create inflation. So if you want to know the primary cause of inflation, you really don't need to look any further than that. I think it was Mark Twain who said that history may not repeat itself, but it often rhymes. And certainly that is true. You can go all the way back to a letter that Mr. Jefferson wrote to a gentleman by the name of Thomas Cooper in 1814. In that letter, Jefferson wrote this, quote, "Everything predicted by the enemies of banks in the beginning is now coming to pass. We are to be ruined now by the deluge of bank paper as we were formerly by the old continental paper," end quote. Well, if you're not familiar with that reference, at about the time of the Revolutionary War, there was $2 million in credit notes issued, and these were called continentals. In fact, there was a term that was used for a very long time after this early currency failed because it was really not backed by anything. It was simply currency created out of thin air. But the phrase that circulated for a very long time in the vocabulary of many Americans is that when they saw something that wasn't worth much, they would say, "That's not worth a continental." Well, it turns out in that 1814 letter to Thomas Cooper, Thomas Jefferson was spot on. It took just 1 year, and the United States entered a depression. And it was kicked off by financial panic, as recessions and depressions often are. Many of you who had money in markets during the financial crisis know firsthand that this is true. Well, this economic downturn that kicked off in 1815 lasted until 1821, and a lot of economic historians would say this was the first boom followed by bust in U.S. history. Interestingly, though, the cause of the boom-bust cycle is currency creation. It is exactly what Thomas Jefferson predicted. Now, this economic downturn, to give you a little bit more historical context, came on the heels of the War of 1812. And policymakers and politicians had to figure out how to pay down the war debt. So they set up a central bank that could create paper currency. Now, economist Murray Rothbard wrote about this in his book, The Panic of 1819, because in order to fund the war, Rothbard writes, these politicians resorted to currency creation. And the federal government didn't create the currency directly. They turned to state-chartered banks to create the currency for them. But the bottom line is this: the paper currency that was created far exceeded the amount of gold that was available to back them. Well, the population wasn't stupid. They decided to hoard the gold. The gold was drained from the banks. And to keep the money flowing, the U.S. government agreed to a temporary suspension of payments in gold from state banks. And this allowed banks to make loans to create more currency with little or no regard for the gold that backed the currency. Well, it was a formula for disaster then, just like it's a formula for disaster now. And I'll talk about this a bit with Karl Denninger in the next two segments. Now, Jefferson understood this. Jefferson was a student of history, and he wrote this in his letter to Cooper, quote, I am an enemy to all banks discounting bills or notes for anything but coin, anything but metals, if you will. But our whole country is so fascinated with this jack-lantern wealth, they will not stop short of its total and fatal explosion. In other words, Jefferson said this will end badly. History teaches us that currency creation always ends badly. Now, I am coming to the end of my time in this segment, but if you are concerned about the level of currency creation that is taking place, if you are concerned with market valuations, I'd invite you to get my packet of information. You'll get the Tax-Free Retirement Income Strategies report. You'll get the Revenue Sourcing book, which contains a retirement planning strategy for the current economy. You'll also get my little black book on Social Security maximization. It is all available by visiting the website, requestyourreport.com. The website again, requestyourreport.com. I'll be back after these words with my special guest, Mr. Karl Denninger. Welcome back to RLA Radio. I am your host, Dennis Tubbergen. I'm pleased to be joined on today's program once again by Mr. Karl Denninger. Karl is a prolific commentator on all things economic and political. Very bright guy. You can read his work at market-ticker.org. The website again is market-ticker.org. I'd encourage you to check it out as I do frequently. And Karl, welcome back to the program.
Oh, thank you very much for having me on.
So, Karl, we were chatting a bit before we started to record the conversation. And when you look at where the United States is as far as financing debt, our debt is now in excess of $35 trillion. I read a statistic recently that 3 out of every $4 collected from personal income tax revenues now goes to pay interest on the debt. That's obviously an unsustainable trajectory, even if you can't do math. How much longer do we have before all this just blows up?
Well, that's, I think, the $9 million question, if you will. It used to be the $1 million question, but then we had inflation. The answer is it's now. And what's been driving this for the last several decades, and I've been raising a stink about it since the 1990s, is Medicare and Medicaid, CMS, known as Center for Medicare and Medicaid Services. That's what it's noted as in the Treasury statements. But the compounding of this that's occurred over the last number of years, and especially the last 3.5 under the Biden administration with Janet Yellen and Treasury, is especially troubling because the game has been, and shockingly, even during the very low interest rates of the Trump administration, was being done too, which is really stupid, is to roll down the maturing Treasury debt into shorter durations. So, it's kind of like you go get a HELOC and you have a 5-year draw time, and then you have 10 years you have to pay it off, right? And so the Treasury issues bonds and bills at different durations, just like anybody else does that's issuing debt. And what they've done is slammed all of that down into the shorter duration as time has gone on. So they've taken all of this longer term stuff that in many cases was at quite attractive rates and put it down into the under 1 year maturity, and specifically, I mean, you could go out to 2 years if you want to, because a lot of economists look at like the 2 year and the 10-year spread as kind of one of the key indicators, right? So they tend to look at it that way. But I look at bills, which are essentially those things that have a maturity of less than 1 year, as being the most important. And we have an utterly enormous, something like a quarter of all of the federal debt outstanding. We're talking about $6 or $7 trillion here that has to be rolled in the next year. And most of that debt was carrying an interest rate of 2 or 3%. And right now, the IRX, which is the 13-week bill, is I'm talking to you, is trading just under 5. So that's about double. And that's where this ramp in interest expense has come from. But it is by no stretch of the imagination over. And so over the next year or so, this is all going to roll into the budget deficit. At some point, the market is going to come to the realization that with the deficit spending going on, which currently, by the way, is about 6.8%. I saw another number that accounted for some other things is closer to 8. But I'm perfectly happy with calling it 6.5 or 6 3/4 or whatever. over 6% of monetary inflation. Now, that is actual inflation going into the economy just from the federal deficit by itself. And then from that, you could subtract, in terms of real inflation rates, the productivity, if there is any productivity gain, because productivity is doing more with less. I mean, that's the definition of it. So the problem is, of course, you and I are supposed to keep that. If we figure out how to do more with less, we should be able to keep the excess, right? I mean, that's the whole idea. You did it. The government didn't do it. You did it. But of course, that's not how people look at things. So we have a built-in inflationary impulse in the economy right now from the federal side today of a little over 6% every year. And over the next 12 months, that is going to become about 8.5. And that's if we make no spending increases of any kind anywhere else. It's just an interest. That's all.
Well, and Carl, this is really a cycle that feeds on itself because, I mean, to use an old cliche, the worse it gets, the worse it gets. I mean, you keep stacking on these escalating interest carrying cost of the deficit gets larger, which of course makes the interest carrying cost gets larger, which makes the deficit get larger. So I mean, this feeds on itself.
Yeah, and the challenge for this is that you do not have anybody out there in the political realm that is saying anything other than what amounts to give somebody some money to do something. Okay. I don't care whether you're talking about Republicans or Democrats, it doesn't make any difference. You have now, in the context of the current budgetary situation within Congress, you have a continuing resolution that has to be passed before the election. Otherwise, the government shuts down. We were told a couple of years ago that there were going to be no more CRs, that just wasn't going to happen anymore. We were going to do the standard 13 budget bills. Well, that was a lie. Now we're up against the wall again. And there is absolutely no chance that the Congress is going to vote that down prior to the election. It's not going to happen. So this impulse within the economy is not going away, and it's being entirely driven by Washington, D.C. So when you hear somebody talk about something like, we're going to give you $35 insulin, or we're going to give you $25,000 as a down payment to buy a house, or we're going to, quote unquote, forgive your student loans. Remember that the government doesn't have the ability to make anything. All it can do is redistribute what it gets. So when you hear that somebody gets $35 insulin, what you really should take from that is the insulin doesn't cost $35. It still costs $500. The person who is consuming it pays $35, and you pay the rest. When you hear someone say, well, we're going to give you $25,000 to buy a house, they can't manufacture the $25,000. They take it from you and hand it to that person. But now that you've shifted supply and demand, the first and basic law of economics, which is always true, is supply and demand. So what's going to happen to the price of houses? They're going to go up by $25,000 immediately. And the entire problem with housing right now, or rent, depending on which way you're on, which side of that aisle you're on, isn't that there aren't houses, it's that they cost too much. So you're going to do something that makes them more expensive and claim that this helps people?
Well, Carl, when you look at this deficit spending, and I'd like to drill down on this because I think a lot of listeners maybe don't quite understand this. Deficit spending funded by easy money policies is by definition inflation. So here you have the Fed talking about a rate cut, taking what amounts to maybe a victory lap on defeating inflation, but we really, the inflation we've had is already baked into the economy. The rate of inflation has just temporarily slowed at this point. Is that an accurate statement in your view?
Well, it hasn't slowed at all, really, when you look at it. I mean, this is one of the big lies is, the CPI is of course what everybody looks at, right? Because that report comes out all the time. This last report that just recently came out showed that the index for shelter was up 0.5% in August. Now, you'd say, well, times 12, that's 6, right? Except it's not, because it's compounded. So if it's 0.5% compounded, it's closer to 7.5 to 8. I mean, I'd have to get the calculator out to do the factorial on it, but it's close enough. So the big problem though is that it's not the escalation on a continuing basis, it's the price level that's the issue. And so saying, well, we went from 8% inflation to 5, that's great. Really? No, it needs to be -8, okay, in order to recover some of that damage. And yet nobody wants to go there. But that's where you have to go, because the idea that's, that you can somehow be okay if you don't do that is nuts. It would take decades for incomes and productivity to catch up with this if we do not have a collapse in those prices. We had this kind of an impulse in the 1970s, and it was almost 20 years later before people really got out from under that, in the early 1990s. I mean, that was a 20-year period of time. That was horrible. And that's the kind of problem that we're facing today, except back then it was in things like groceries and energy, but where it wasn't was in housing, and now it is. And housing is one of those things that you absolutely have to have. There isn't any way around it. And the other area that you're getting is a lot. What's driving this is, for the most part, it's medical care expenditures within the government, and the government's policies are deliberately driving things that make people ill, and then they're profiting from it, and it's being siphoned off. And so you have a barbell economy. You have the people at the very top who are making an awful lot of money, and then you have everybody at the bottom that's getting stepped on, and essentially the economy is bifurcating into what amount to slaves and royalty. And I mean, certainly not formally that way, but from an economic perspective, that's what's happening. We are not far away from the markets deciding they've just had enough of this. And it will happen, because at some point you're going to have the folks at Goldman and, and the other banks, the primary dealers, and everybody else are going to say, look, I've got people that have credit cards that are being charged 29% interest. They're not able to pay. They're charging their groceries. All those people know exactly. I mean, they know that, okay, this percentage of your check is being, is being run at Kroger, right? I mean, on your credit card, because they get all that record level data. These people are not able to pay their bill at the end of the month. Well, at the point that they stop paying for those kinds of things because they can't, we're not going to be able to collect on that so-called 29% interest. It's essentially zero, because you can't get blood from a stone. And by the way, the guy ate the food, so you can't repossess it either. And that's the point at which the cost of borrowing from the government side goes up, because people say, well, we may be the best looking horse in the glue factory compared to other nations. And, and I believe we still are, but it's still a glue factory.
Well, my guest today is Mr. Karl Denninger. His website is market-ticker.org. The website is market-ticker.org. I'd encourage you to check it out. I'll continue my conversation with Mr. Karl Denninger when RLA Radio returns. Stay with us. I'm Dennis Tubbergen. You are listening to RLA Radio. My guest today is Mr. Karl Denninger. He is a prolific commentator. You can read his work at market-ticker.org, market-ticker.org. And Karl, in the last segment, we were talking about the fact that at some point, you believe that markets will decide, hey, we've had enough of this. So when you talk about markets, let's be a little bit more specific if we could. What does the U.S. government bond market look like, and how will stocks be affected?
The most likely scenario is that in the bond market, right now we have an unprecedented situation in the modern era, certainly all the way back to the 1970s, which of course was when everything became formally fiat, right? The gold standard was formally ended, although technically, if you want to really get down to brass tacks, it was the Depression when that happened. Okay, it was when the government decreed that if you couldn't privately own gold, there was no market for it, so there was no price. So I mean, if you really want to get down to it, the modern era really starts, 1929 after the crash. But what we have is an inverted curve where the short-term rates are higher than the long-term rates. And what that is telling you is that people in the market believe that it will be less expensive by a substantial amount to borrow for 10 years than to borrow for 13 weeks, which is the IRX. There's a problem with this, and that is that time has value. I'm 61 years old. I can never get any of those years back. Therefore, every year that passes has some kind of value to me, and it does for everybody else as well. So if you have a 10-year Treasury is trading at 3.7 approximately, which is about where it is right now, and there's about a 2% time value in that because it's 10 years, what you're really saying is that people believe that the rate of interest over 10 years should be about 1.5%. Well, when you have the government putting 7% inflation into the system every year, how does it make any sense to loan anybody money for 1.5? Well, that's a loss of 5. Okay, that's crazy. Nobody in their right mind would do that for any length of time. So at some point, this snaps back. And when it does, you'll have a short-term downward movement in the longer end of the curve because as people sell stocks, the money goes somewhere, right? So where it will probably go is into the Treasury market in the initial sense. But then quite quickly you get a rebound because that's a one-time deal. You sell the stock, well, okay, you sold it. It's you put it in Treasuries, well, okay. And then you lose money again because the price of Treasuries is the inverse of the yield. So if you chase the 10-year down here at 3.6 and you buy 10-year bonds, and then the 10-year Treasury rate goes to 5 or 7, you're going to lose half your money in the bond market. People don't have any comprehension of this in the general equity world, but believe me, people that trade bonds do. The trade of the century was probably in the late 70s, early 80s, when people bought 30-year bonds. And you could sit on them for 30 years and collect the coupons, which was an unbelievably profitable thing to do. Or after 4 or 5 years, when rates started to come down, you could sell and make 50%. But it was just because you had a 30-year coupon there that had to be paid for the next 29, 28, 27 years. This is going to be the exact opposite. Why would you buy a 10-year bond from me that pays 3.7% when you can buy a new one that pays 6? You wouldn't, right? I mean, that would be stupid. So the only way you're going to buy mine is if I give you the discount and the difference. And that's how you lose money in the bond market. So my expectation is that you're going to see all of the hot air come out of the equity markets, tremendous decreases. And at the same time, people are going to pile into the bond market, anticipating that that's a safe place to stay. And then they're going to get slaughtered again because until the government stops the deficit spending, which is you're going to have to go with the root causes. You can't just cut spending by that amount. It isn't going to happen. There's no possible way to do it. You've got a real problem. And that's where we are right now. This entire issue within the federal budget is centered in CMS, the Center for Medicare and Medicaid Services. We have created this wave of illness, chronic sickness, and expense. And it has been done either with willful disregard or even worse, deliberately. I don't know which is the case, but it doesn't really matter. The impact is the same. We create a bunch of expensive things. They don't actually solve problems. They make the problem worse and therefore create a recurring subscription requirement that you pay for the rest of your natural life. We are doing this all the way down to children at this point. And this is one thing that RFK has pointed out, and he's right. Exactly where it's happening is not so clear, but that everybody has an incentive to brush the root causes of this under the rug is absolutely true. And this is not genetic. It can't be. Genetic changes like this take hundreds or thousands of years to show up. This happened in the space of 40. So this is environmental. It is what is being consumed by the people in the United States and to some extent across the world. And if we don't get it under control, the only alternative is we're going to have to let people suffer. So that's those are the only two possibilities. This is not going to be fun. And the people that think that AI is somehow going to solve this, or computers are going to solve this, or we're going to technologically whatever our way out of it. Oh no, we're not. This issue has to be faced head on, and it has to be addressed. And it's not going to happen until there is a all-on route in the asset markets.
So, Karl, couple follow-up questions here. Let me start with stocks. You mentioned a route likely has to happen. We've got Warren Buffett dumping Apple stock, dumping Bank of America stock, raising cash. That probably is all we need to know about stocks. Do you have a forecast for where you see stocks going?
Well, I mean, if timing is always the problem, but there is no world on this planet where large established companies like Microsoft can reasonably sell at 15 times sales. They might be able to sell at 5. So does that prognosticate a 2/3 loss? Yeah, it does. And that's among well-established profitable firms. Those that have been blown up with hype and hot air, NVIDIA makes great graphics cards. I've got 2 of them in my house. Okay, different computers. But the idea that they're going to take over the world with artificial intelligence is something that has never been demonstrated in the history of computing technology, and I don't believe ever will, because we don't even understand how human intelligence works. We don't know how the brain works. How can you model something that you can't describe? That's ludicrous. And this is a company that split 10 for 1. Well, if you go back and you look at, okay, where were they before? $30 to $40. Well, what is that at 10 for 1? It's about $4. Do I want to be anywhere near a stock's trading over $100 a share when I think its value on a forward basis is $4 or $5? No.
So, Karl, the other half of what you talked about was, this government deficit spending creates inflation, and you mentioned that a lot of the problem you see is in Medicare and Medicaid. Is this problem fixable, or does this have to go through a reset where we just scrap what we've been using and we just start over?
Well, you can't scrap what you've been using, because that's essentially that's the argument that you have a lot of people that say, well, there's this great reset, the World Economic Forum guys and stuff like this. What you have to realize is that for every debit on someone's balance sheet, there's a credit on the other side somewhere. And so you say, well, we'll just scrap this. Okay, well, what do you do about the people that are owed all the money? Okay, they're not going to accept that. So, I mean, can you have that kind of thing happen? Yeah, through a violent revolution when half the people in the country get killed. I don't think any of us want to go there. So, I mean, but historically speaking, how do we get the kind of situations that we had in World War II, where America was, for the most part, the only place that still had a manufacturing base? And it wasn't because we were better and smarter than everybody else. It's because we blew up everybody else's stuff. So, I mean, you don't want to go down that road as to how we get out of this mess, especially not in a world where an awful lot of people have nuclear weapons and there's no such thing as a moat like we had back before those times. I don't think that's realistic. I think ultimately what has to happen is that saner people have to come into the room. I don't see it in the current political context, which gives me a great deal of pause, because you don't have a choice today that's going to take you there. But the saner people have to come into the room, and they have to say, look, the essential farming of human beings under false pretense, whether it be all of the yelling about alternative energy, we want to use solar panels. Well, that's great, but the sun doesn't shine all the time, which means that you have to have on standby and pay for something that is reliable, whether you use it or not. This means the price is going to go up dramatically. We cannot afford to do that. And oh, by the way, behind every single thing produced in an economy is energy. Everything. It doesn't matter what it is. There is nothing that is produced in an economy without energy. Until we have people that are willing to sit at the table and say, no one wants fouled water, poisoned air, and destroyed land. No one. However, We have to have a functional economy that works for everybody, and we cannot treat people as farm animals. And therefore, we're not going to do that. And if companies try to do that, we are going to step on them, not you. And we're going to sort out these problems. We're going to find out where this has been done. We're going to stop it. And the savings from that will come because the spending won't have to take place anymore. Now, instead of spending money on something that has no benefit, now that money can be spent on doing things that actually advance the human condition and advance the economy for everybody. But that's not a fast process. It doesn't take place in a week or a month or a year. And in the meantime, all that hot air that's in the system right now has to come out. And it's going to come out. There are going to be massive losses taken by people that currently hold the other side of the balance sheet on those debts. It's going to happen.
Well, my guest today has been Mr. Karl Denninger. His website is market-ticker.org. The website, again, market-ticker.org. Karl, I can't believe that 25 minutes went by so quickly, but it did. Thank you for joining us today, and I'd love to have you back down the road.
No, anytime. Thank you.
We will return after these words. This is RLA Radio. I'm your host, Dennis Tubbergen. Glad you're listening in today, and thanks again to my special guest, Mr. Karl Denninger, for joining me on today's program. In this segment, I want to focus on a particular asset class. I'm going to call this segment Investing Spotlight, and I want to dig in a bit on the heels of what I talked about in the first segment today and talk about investing in the precious metals market. And in particular, I want to talk about silver. Now, let me say at the outset of this segment that I am offering you general information only. Please do not consider this to be investment advice, and please ensure that you consult with an appropriate professional to determine if investing in silver makes sense for you. Now, as a lot of you longtime listeners are aware, I think that silver has some of the best upside potential moving ahead of most any asset class. Now, there's a few reasons for this. And as I talked about in the first segment, the very first reason is the inflationary environment that exists presently. Now, despite the fact that the Federal Reserve has signaled that we have an interest rate cut coming soon, despite the fact that they are pivoting or reversing their position, it seems pretty obvious if you've been to the grocery store that the inflation battle has not been won. Now, perhaps the rate of inflation has slowed. Certainly, as the government measures inflation, that has been the case. You need to remember that the massive inflation that we have seen over the past 4 years or so, all those price increases are now baked into current prices. We're not seeing price declines. Prices are still going up. What we're debating is the rate at which prices are increasing. So a slower rate of inflation simply means that these already high prices are still rising, just maybe a little bit slower than they were rising previously. Now, with this upcoming Fed policy shift, it's my opinion that we have near certain higher inflation ahead, and I expect that tangible assets and gold and silver in particular will likely continue to perform well over the long term. Now, to this point, certainly if you look at 2024 year to date, gold has outperformed silver. Now, I believe that that could potentially change moving ahead, and one of the reasons that I think that is something called the silver to gold ratio. Now, the current spot price of gold, just to round it off, is about $2,500 per ounce, that is, and the current spot price of silver is about $28 or about $28 an ounce. So that gives us a silver to gold ratio of approaching 90. In other words, when measured in US dollars, 90 ounces of silver is approximately equivalent in value to 1 ounce of gold. Now, that 90-to-1 ratio that's called the silver to gold ratio is extremely high by historical standards. Since the U.S. dollar became a fiat currency back in 1971, that's when then President Richard Nixon eliminated the link between the dollar and gold. The average gold to silver ratio has been about 50. So if the average is about 50, going back to 1971, and we are presently at 90, it tells us that if this ratio were to go back to the historical average, and if the silver to gold ratio were to return to the level of 50, if gold doesn't move, that puts silver at about $50 an ounce, up from presently just under 30. It's almost a 200% price move. Now, I have suggested that if gold does in this bull market what it's done in past bull markets, we could see a move from the beginning of the bull market to the end of the bull market of 7 to 8-fold. That would put gold somewhere between $7,000 and $8,000 per ounce. And that would put silver at maybe $150 an ounce. And if that were to happen, that would be a move of about 500% from current spot prices. Now, obviously, this is all speculation, but certainly the conditions are right for precious metals to perform quite well. Now, the other piece of the story when it comes to silver is that industrial demand for silver is now exceeding mining output. Now, silver mining output, according to the Silver Institute in 2023, fell by 1%. Now, demand also fell, but demand, despite the decline in demand, was still at about 1.2 billion ounces. So a little math has one concluding that the mining output of silver falls short of industrial demand by about 369 million ounces. So there is another reason that I believe silver could do quite well moving ahead. Silver demand from China increased 44% to 261 million ounces last year, again, primarily for green energy applications. Now, I could go on more about why I think silver could do well. There's certainly some technically favorable chart patterns with silver as well. If you'd like to learn more about this, you can give the office a call at 866-921-3613, and we'll be glad to let you talk to somebody. 866-921-3613 if you'd like to have us answer some questions for you. And if you'd like to get some more information, I would invite you to get the box of information I'm offering on today's program. It contains the Tax-Free Retirement Income Strategies report. It contains the Revenue Sourcing book, and it also contains the Little Black Book on Social Security Maximization. You can get that information by visiting requestyourreport.com. That's all the time I have for this week. I'll be back again next week.